Let's get right to the breaking economic news. The May jobs report was released just moments ago, and it shows that the U.S. economy added 272,000 jobs last month, above what economists had expected. Let's bring in CNBC's Dom Chu. Dom, thanks for joining. Let's get your reaction to that number, jobs added, and also where the unemployment rate stands.
Sure. So the 272,000, as you point out, much higher than expected, also a tick higher in the unemployment rate. Let's put some detail around the headline numbers that we just showed you. From an economic perspective, the numbers are generally more positive than negative, at least from an economic perspective. At least that's the way traders and investors on Wall Street are reading into it. What I can tell you right now is that whether you believe in the story those numbers are telling, people who have put money at risk in the market have made their call for now. As you can see, stock futures are lower, interest rates have ticked higher. The drop in the value of the stock market, the drop in the value of U.S. government bonds, and the subsequent tick higher in interest rates has to do a lot with the strength of the economy and whether the Fed can lower or raise interest rates in the future. Getting into some of the details around that report, the sharp increase versus expectations in the headline jobs number is generally viewed as positive. The tick higher in the unemployment rate amid less labor force participation is also more on the negative side. The household survey that is used to calculate the unemployment rate also showed that the number of Americans that say that they currently hold a job actually dropped by around 408,000. That is definitely a negative. Average hourly earnings, which is under a lot of scrutiny, intense scrutiny these days, given stubbornly high consumer prices and the inflationary picture, that came in better than expected on both a month-over-month and a year-over-year basis. So Americans on average per hour were improving their income by 0.4% on a month-over-month basis, which brings you to a 4.1% gain on a year-over-year basis. Now, that's being viewed as generally positive. Now, as for where the jobs are, the biggest gains came from healthcare, which added 68,000 jobs. Government hiring added around 43,000 jobs. Leisure and hospitality added 42,000 jobs. Now, those three sectors alone accounted for more than half of the total gains in the headline jobs report number. We also did see, by the way, gains in areas like professional services, social assistance, and retail. Now, as I pointed out, Wall Street is taking this report as one that perhaps puts more pressure on the Fed in its decisions down the line to possibly keep interest rates higher for longer, given that stronger jobs kind of picture overall in America. As a result, as I point out, benchmark 10-year U.S. government note yields, U.S. sovereign bonds on the long-term basis, actually fell in price to lead to a 10 basis point jump in yields or interest rates. Stock prices, as you can see there, were implied lower by roughly 135 points on the Dow. We were relatively stable to flat going into the print. So I guess, Jonathan, guys, the read into this right now is that the inflationary picture is still one that you have to deal with, and that's the reason why, at least for now, in this pre-market trade, traders are assigning a little less value to both U.S. government bonds and the U.S. stock market overall, guys.
So, Dom, this week we saw the European Central Bank cut interest rates in Europe. That puts Europe now ahead of both the UK and the US when it comes to cutting those interest rates. What do you think the chances are, and I know there's been some talk about this, that the American economy is just too hot for too long? We were all talking about the idea that we'd managed the soft landing. Is there some doubt now about that? Is there some concern that these hot job numbers are just going to keep the Fed feeling a little cautious about the long-term prospects of bringing down interest rates here?
I mean, that's the real issue right now, right? So the entire market narrative over the last several months and quarters, and maybe even the better part of a year, has been that the U.S. economy will avoid a recession. It will avoid any kind of a real hard landing, that the worst that we are going to get is a softer landing, or maybe even no landing at all, that the government can keep the economy, keep it moving, albeit at a slower pace than we saw in the wake of the COVID pandemic and the recovery since then. What we have right now, though, are anecdotal signs, not just amongst the data, but also in corporate America, that there are signs showing cracks in that consumer economy here. What we have seen seen throughout the course of this corporate earnings season is many of the retailers who cater towards lower to middle income Americans, those who are more value-oriented shoppers, showing signs that they are actually pulling back on some of that spending because of the persistent problem of higher prices for longer. That may have to keep the Fed more focused on making sure that inflation is remaining contained before it can do anything with regard to cutting interest rates. Now, you know, Caddy, as I will point out, you pointed out here, the ECB has cut interest rates. I will point out that the interest rates between Germany and U.S., you know, two very big developed economies, they are still at some of the lowest differentials that we've seen in a while. So despite the fact that the European Central Bank is lowering rates right now, it's not as if there's a massive divergence in interest rate policy at this point. And yes, the U.S. economy does appear to be more resilient than other developed market economies around the world, which is why the Fed is in a very difficult spot right now, a difficult spot of having to navigate what is a higher level of growth than other places in the world, at the same time having to be cognizant of the idea that the consumer may not be as resilient as we thought. So this is a very kind of transitional period for the economy, one that's going to be very interesting to see play out, especially as we head towards the uncertainty of the elections in the fall.